Hello and welcome to Mint Funds Update. My name is Marek Krzeczkowski and I'm joined by Ryan Falls. Today we will talk about market outlook and what happened within diversified funds in February. March has been a very interesting month so far. US President Donald Trump delivered a swift trade war with tariff increasing the risk of recession. Both inflation and growth outlooks have deteriorated from where we were last month. And we would expect that increased volatility until the dust settles, which may take some time. We have seen tariffs across China, Canada, and Mexico, and there is obviously a lot more to come from what the US president is saying. As a result of these actions, if you look at the left-hand side, what we have here is the economic policy uncertainty index that has been an all-time high. So there's a lot of uncertainty. However, what we would stress is that at this point, the probability of recession is still relatively low. So here on the right-hand side, you can see the Bloomberg consensus and also what Goldman Sachs estimates. And roughly where these are now is around 30%. However, what are the main risks and why markets are selling off at the moment? So if we take the scenario of a full-blown trade war, inflation is likely to increase and stay elevated, at least until the mid of 2026. Here on the chart, what you will see is a dark blue line is the baseline scenario of 10% tariffs on average. That means that scenario would increase inflation to around 3% and inflation would come down. Also in that scenario, whilst it's not great to see inflation coming back, there is still some room for Fed to respond to any slow in the growth at the end of the year. Now, what markets are really concerned at this point is the red line, what we call a risk scenario. Here we have the reciprocal tariffs and on average tariffs across the board increased to around 15%. That scenario would be quite challenging because inflation would rise above 3%, would stay elevated till the mid of 2026, and it would be hard to see Fed being able to respond quickly with inflation being over 3%. At the same time, as a result of the tariffs that have been implemented, the GDP expectations have grown. So overall, what we've seen in the last month is increase in uncertainty. Inflation outlook has now deteriorated to a point where higher inflation can be expected. And at the same time, GDP growth is at questioned, and the strength of the economy, the US economy, will be tested. Now, saying that, even in the sort of the risk scenario, we still the Goldman's and our view is that we would still see a positive real GDP growth in the US. Now, moving on to New Zealand, I'll pass on to Ryan.
Thanks, Marek. So quickly taking you through what happened over the month in February for New Zealand. We had the RBNZ February monetary policy statement, and Monetary Policy Committee duly delivered their 50 basis points cuts as expected. And they also updated their forecast showing that now the central bank has aligned to market pricing for OCR of being around terminal being around 3 to 3.25%. So if you quickly look at this chart, you can see the difference from the February monetary policy statement versus November one, and effectively we see the RBNZ OCR track getting there slightly faster than previous, but effectively to the same endpoint of around 3.25%. Turning now to the performance of the diversified funds and starting off with the income fund. So asset class performance was broadly positive in February, and the fund was up plus 0.3%. As markets broadly sold off on tariffs implementation and then obviously the reprieves, and this caused some growth concerns to permeate both equity and bond markets. So fixed income was the largest positive contributor, plus 0.3%, with Australasian and global equities coming in flat for the month. Turning to the positive contributors, Within fixed income, we've seen divergence in US rates and other markets as growth concerns finally started to permeate on the back of the tariffs. Markets broadly took the implementation as more growth negative than inflationary, so as such US rates fell. New Zealand rates actually flattened, with long end rates following the US down and then short end actually rising. Within global equities, we had Tapestry Incorporated up 17.1% and Visa Incorporated up 6.1%, and they're the top two contributors in February. Tapestry surged during February after announcing broad growth across its range of designer products in the 2024 holiday season, with Coach handbags being their standout product. Within Australasian equities, we have Megaport up 30.5% and Charter Hall Group up 8.9%, and they were the top two performers for the month. The market reacted very positively to half H1 earnings from Megaport, with an 18% rise in recurring revenue for the first half of the fiscal year for them. Turning to the negative contributors, within global equities, with Amazon Incorporated down 10.7% and Thermo Fisher Scientific Incorporated down 11.5%. They're the two main detractors. Amazon struggled after announcing earnings at the start of the month, and despite overall revenues growing above expectations, they missed some key numbers, particularly within their AWS cloud computing segment, which sent the stock down negative 4.1% after that release. Turning to domestic equities, we had CSL Limited down 7.1% and Goodman Group down 14.1%. The two main detractors for the month. Goodman Group had strong earnings released for the first half of the fiscal year, but markets were a little blindsided by their capital raise of 4 billion Australian dollars, which was deemed as necessary to fund their data center developments. Turning now to the Mint Diversified Growth Fund. So asset class performance a bit more mixed in February for the Growth Fund, as markets broadly sold off on those tariff implementation reprieves. The fund actually came in flat for the month at 0%. Looking at the individual asset class breakdown, Australasian equities was down negative 0.1%, and that was only a small detraction, with global equities and fixed income coming in flat to 1 decimal point for the month. Turning to the positive contributors, within global equities, we had Tapestry Incorporated again up 17.1% and Aon PLC plus 10.3%. Aon actually started the month off with a bang, with Analyst beating earnings announcements, with operating margin at 33.3% and earnings per share 4% above where analyst expectations were. In Australasian equities, we had Megaport again up 30.5% and A2 Milk Company up 37.3%. Two very strong performers for the month. A2 upgraded significantly during the month after releasing a very positive earnings result for the first half of the fiscal year 2025. And this is all driven by higher revenue growth and then also interest income. Within fixed income, our curve positioning broadly helped offset any of the losses from yield curve flattening in New Zealand. And turning to the negative side, within global equities, we have Trade Desk Incorporated down 40.8% and Thermo Fisher Scientific down 11.5%. Trade Desk Incorporated slid nearly 33% in the days following their Q4 earnings release in February, and this is after them missing revenue expectations, and then management also revising down Q1 25 guidance after poor performance of their Kokai advertising platform. Within domestic equities, we had CSL again down 7.1% and Goodman Group down 14.1%, two main detractors for the Growth Fund. So CSL had a mixed earnings release for the first half of the fiscal year, but however, analysts were skeptical of management's ability to deliver on the second half fiscal year gross margin after noting poor performance in their Seqirus vaccine business unit, which caused the stock to slide.
Right, thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.